My name is Jason Choy, Senior Portfolio Manager at InvestNow, and welcome to the February 2024 edition of InvestNow's Market Wrap-Up. At InvestNow, one of our guiding investment principles is to stay informed but avoid the noise. That means that while we recognize it is important to keep abreast of what's happening in markets, we also believe that investors should be mindful of resisting the urge to change their long-term investment strategy solely in response to market volatility and noise. We know, however, that financial markets can often feel unnecessarily noisy and complicated. With so many headlines clamoring for our attention, it can be hard to keep up with what's relevant and what isn't. But don't worry, InvestNow is here to help. Each month, together with one of our expert fund managers we have on the platform, we'll distill the key events in the wide world of investments into digestible bites curated for the Kiwi investor. Today, I'm joined by Greg Smith, Head of Retail at Devon Funds Management, one of the leading fund managers we have on InvestNow. Greg represents Devon across multiple channels, with a particular focus on growing Devon's presence with advisors and retail investors. Greg is also a well-recognized market commentator, including appearances on the likes of Bloomberg and CNBC, as well as regularly providing his market insights on News Talk ZB and authoring his own daily wrap-up of market events, the Devon Funds Morning Note. We're lucky to have Greg join us here today to help break down an interesting month of the market in February. Greg, thanks for being here today.
Well, thanks, Jason, and great to be here. Thank you for having me.
No worries, mate. So let's kick into the February market wrap-up then, shall we? As it's once again been an eventful month, particularly with it being an extra long February with the extra leap year day. So, Greg, February's come and gone, and we've got this market dashboard which handily summarizes the performance of a few key indices like local as well as global bonds and shares. And we can see that international equity markets saw strong gains over the month, contrasting more muted performance locally, while fixed interest once again struggled. Were there any particular sectors or indices that stood out to you over the month, Greg?
Oh, yeah, certainly did. And of course, what we probably saw in February was really a continuation of the strong start to 2024 that we saw in January, and of course, really which began, you go back to October last year. So, the bulls are sort of firmly back in the stable, as it were. And you look at that, the US shares, leading from the front, up over 5%. Of course, it's well documented that the Magnificent Seven have been leading the way, or parts of the Magnificent Seven at least. And of course, led by Nvidia, over the last sort of 4 or 5 months or so, and that continued to a certain extent into February. AI has been the buzzword, and even companies that have nothing to do with really AI sort of seem to be getting in on their sort of conference and investor calls. But it was more that, again, the US leading from the front, and a lot of that to do with the outlook for rate cuts. And there was, at the start of February, we were expecting a rate cut very soon, or the market was, and then that sort of evolved over the course of the month, as we had inflation prints and other data. But that was sort of left in front. But actually beyond the Magnificent Seven, there were other stocks sort of making new highs as well. So you had sort of more old-fashioned names. You look at the US, likes of Visa, likes of Abercrombie and Fitch, Uber, made record highs. So it wasn't just all about the Magnificent Seven. Global shares, as you can see there, did very well, as did risk assets. You'll see, obviously, Bitcoin down there, very volatile, not one for the faint-hearted by any means. And crypto assets with Bitcoin leading. But the interesting one about global shares as well was it wasn't the Nasdaq that was the best performing index during the month or year to date. It was actually the Japan's Nikkei, and you saw record highs there, and you saw the level. Japan, unlike the rest of the world, has been really battling deflation for a long period. So inflation, they've actually been quite appreciative of that, and investors also attracted by corporate governance there in that market, and a negative interest rate policy which has continued. So the Nikkei was a standout, but overall it was a very positive month for global equities. Of course, you look at NZ shares, they're lagging a bit. Just worth pointing out quickly as well, earnings season in the US went very well. Over 80% of companies beat on expectations. It was a bit more of a mixed bag in New Zealand, and we'll come to that.
Cool, thanks, Greg. So kind of speaking of record highs, we saw both the Dow and the S&P 500 once again notch record highs over the month, with the S&P 500 in particular hitting the psychologically important 5,000 level. So you can see from the chart here that up until the most recent kind of mark, each 1,000 level milestone was has taken a shorter and shorter time to reach. So that first 1,000 took around 41 years to achieve in 1998. The 2,000 level was hit 16 years later in 2014, 3,000 just 5 years later in 2019, and then 4,000 less than 2 years later in 2021. Obviously, the bear market in 2022 threw a bit of a spanner in the works, but since late last year, the S&P 500 has been on a tear, rising over 20% in just the 4 months to the end of February. So, Greg, could you maybe give us some insight into what were the main drivers for the most recent rally over the US, where we've seen markets rise in 16 of the last 18 months, so something we haven't seen in over 50 years?
Oh, that's absolutely right. So, look, I think technology has had a lot, but not all, to do with it. We are seeing a lot of these big super cap names, reach over our own territory, and that's probably not a particularly new story. But when you've got a company like Nvidia that goes above $2 trillion US in market cap, you're dealing with some fairly sort of formidable beasts. We could probably do a whole webinar as well on sort of algorithmic trading as well. How you see a market or you see a stock rise, and then it's sort of a self-perpetuating story. But it was interesting that a lot of these growth names sort of did deliver during the earnings season. The bar of expectation was quite high, and in many instances, companies made it. Worth pointing out, though, as well, that the revenue line was softening in many instances, and you're probably expecting that with a slowing economy. But a lot of these tech names are actually increasing their earnings by becoming leaner. It's actually ironic in a way that AI is such a big story, but it's a good potentially for the industry, but not so good for some employees within that industry. In fact, layoffs in the tech sector are the highest since going back to 2001 and the dot-com sort of crash. But you're seeing more old-fashioned names do pretty well, and ultimately, I think it was that macro tailwind as well there, Jason, with the potential for Fed rate cuts. But we did see during the month that timeline for the proximity of those rate cuts pushed out a bit, which sort of saw bond yields move around a little bit.
Cool. Yeah. So maybe touching on one of the points you made there. So while much of 2023 was driven by the performance of a concentrated few, so namely the Magnificent Seven, the most recent rally we've seen has been across a broader group of names, and a bit more fragmentation we've actually seen in the Mag 7. So as you pointed out, Nvidia is up 60% in just the first 2 months of the year, but Tesla's down 20% over the same period. So Greg, do you see much of the 2024 performance to be driven again by a set of concentrated names, not necessarily the Magnificent Seven, or do you feel there's a broader rally is almost inevitable in the market?
Yeah, I mean, we have sort of a value tilt at Devon, and I think we're probably if we're looking at a trans-Tasman equivalent Nvidia, we certainly wouldn't be chasing that at these sort of levels. But obviously, some in the market are. Probably a problem for a growth stock like that the bar of expectation keeps rising, and exponentially so. So it's not to say Nvidia won't sort of keep on going for the for the rest of the year. But as you point out, Jason, some stocks have certainly lagged, and arguably Tesla should not be in the Magnificent Seven, perhaps the Maleficent Seven or something along those lines. We've seen, and they're actually they've been price cutting to try and sort of prep up sort of the EV volumes. And the EV transition has actually been it hasn't lived up to expectations at all. In fact, we've seen traditional combustion sort of cars sort of do better. A lot of motor companies or traditional motor manufacturers are sort of tilting away from EVs a little bit. So it just shows you that that these sort of glamour stocks sort of can have the day. So I think we are going to see a bit more of a broadening of of the market rally this year. I think we still go higher by the end of the year, but there will be, as you say, it's never a straight line. It is going to be interesting to see where this AI thematic goes, and any technological innovation throughout history often falls short of expectations in the short term, and there's a stage called the trough of disillusionment. So the near-term implications of technological innovations are often overestimated, whereas the longer-term implications are often underestimated. So we'll see, where AI goes in this cycle. But I think, the important point for the US stock market is how the world's largest economy transitions. Do we get that soft landing? But, if you're in the soft landing camp, you're probably joined by 99% of the market at the moment. So that's nothing particularly new. But if we do get that outcome, and we do get those rate cuts at the same time that the economy's tended to hold together, then that could be very good for the performance of the US stock market through 2024, and I think a broadening of the sort of the haves and have-nots, if you like.
Nice, yeah, and that's probably a nice little segue into the other major asset class. So turning to bonds a little bit, which saw a second consecutive month in the red as yields rose across the board. So, Greg, could you maybe provide some insight into some of the drivers behind the poor showing from fixed interest markets lately, and why we've returned to this negative correlation? So, as a reminder, that's kind of where bonds do well, or then equities do not so well, and vice versa. So this kind of contrasts what we saw in late 2023, where bonds and equities were almost performing in lockstep. So what's changed since then, where we're kind of back to the status quo now?
Oh, so yeah, it is resumption at status quo, as you say. Then typically it is because if you look, particularly if you're looking at sort of growth stocks, if you got rates at zero, $1 million in 10 years' time is worth the same as $1 million today. So growth stocks perform very well when rates were zero. Then growth stocks or your high PE stocks and the like, high valuations, really struggled. Remember 2022, we saw bond rates heading up towards sort of 5% in case of the US 10-year, and we have it has been sort of mean reversion in terms of historical perspective there. But we have seen it shift around a little bit of late as well. And we've seen obviously the market start the year with the fact we're going to get, or the idea that we're going to get rates cuts in the Fed by the Fed, should I say, in March, and that that hasn't happened. The timeline for that's been pushed out. So you saw bond yields pick up a bit, but then you've also seen the appreciation that rate cuts might not happen today, might not happen tomorrow, but might happen in the next sort of few months' time. And the stock market is very much forward-looking, and I think that's why you're seeing it sort of back to sort of normal service. Ultimately, the reason why we're going to get those rate cuts, in the next sort of few months, if not later in the year, it's pretty similar across most economies. Inflation has come down from those peak levels. In some countries, it's come down to a greater magnitude than others. So the US, for example, versus New Zealand, it's come down quicker. It is proving sort of sticky in places. Even in the US, you look at rents and shelter, which is a big component, that's sort of being slow to come down. But it is coming down. So meanwhile, the economy has held together. We've seen very strong jobs numbers. We've seen sort of very strong data points in the US, but and that's sort of also, I guess it's provided sort of the Feds the luxury of patience, really. And we're seeing a similar story elsewhere. We've got bond yields in the UK and France and Germany there, which, by the way, those two markets, France and Germany, both recently hit record highs as well. Again, inflation's come down from double-digit levels. Economies haven't fared quite as well. You've seen Europe in recessionary conditions, as is the UK, but economies are getting through it. And I think that's what the market is starting to acknowledge. When the bond market is, and when yields are sort of gaining week on week, there's sort of fears there over, are we going to see that deep recession? I think that's now potentially off the table, and I think that's why you're seeing a bit of a reversion and seeing strength in equities and sort of bonds resuming their decline.
Yep. So it's more a question of not if, but when, and the when is the big question mark, because and that's always what leads to jitters in bonds market. So thanks for that, Greg. Great insight. So maybe moving forward to key events that are closer to home for the Kiwi investor. So the big events over the month was, of course, the first Reserve Bank of New Zealand monetary policy meeting. So of the year, which occurred at the end of Feb. So this saw the RBNZ keep the official cash rate steady at 5.5%. Greg, can you talk us through the market's reaction to this? As I know there were a few leading bank economists that were calling for a couple more rate hikes to kick off 2024. So what was Devon's view on all this and, the RBNZ's more balanced response to start the year?
Certainly was. And look, hats off to him. There was a lot made of the fact that call for 2 rate hikes was, it wasn't proven correct at the meeting, but hats off to sort of also acknowledging that. But we sort of said on our start of the year projections, if you like, sort of crystal ball gazing to clients, that we thought, the RBNZ would cut rates a lot sooner than the market expected, and certainly a rate cut, if not 2, in 2024. We still think that's the case. And I think the thing about that meeting that sort of surprised a lot of investors was, it wasn't dovish, but it was a lot less hawkish than expected. And you've got to remember the RBNZ was the first central bank, bar Norway, to raise rates. They've continues to be quite hawkish, but I think the one thing that the RBNZ and Adrian Orpeta have been concerned about is the economy not cooling down? Well, it certainly has. About inflation being persistent, that's still true a little bit. About high levels of migration. And that we're certainly getting those high levels of migration, and that is actually masking what is a pretty, we've got GDP numbers, a pretty sort of meager underlying performance. If you look at how our economy is performing on a real and per capita basis, it's not great. So migration is sort of something that's helping. The question will be, whether a key driver of our economy, the consumer, which is already facing some challenges, whether that sort of deteriorates further. At the moment, Kiwis are getting by, they're paying their mortgages, their rates have gone up and so on, but they're getting by, they're cutting back on discretionary expenditure. But, just will there be a bit more of a tipping point as more people sort of go onto those higher fixed rates? And I think that could be a bit of an issue. Manufacturing sector is still quite challenged. Few green shoots there. Property market still challenged. So I think we see still a rate cut in the second half, if not more. And that I think the RBNZ's path there will be made a little bit easier if they're not the first move, and I don't think they will be. We're probably going to see the Fed cut rates before then. We'll see the ECB cut rates before then. We'll probably see the Bank of England cut rates. So I think, we'll see that projection line, I think, sort of dip down further. And that, could actually be a really positive driver for the New Zealand stock market in the second half of 2024. Obviously, we're a yield-heavy market. Rates go down, those dividend yields become a lot more appealing, but also if the underlying economy is becoming a bit more resilient, helped by rate easing, then we could be looking forward to a much better start to 2025 in terms of our economy, and the market might price that in later in the year.
Nice. So we definitely see, at least from Devon's perspective, rate hikes a lot earlier than 2025, which is what the RBNZ is currently projecting.
So watch this rate cuts too.
Yep, that's right. Sorry, rate cuts. Yep. And so maybe it's a nice little segue into what's happening in the New Zealand stock market. So other big market driver in New Zealand over February was, of course, earnings season for New Zealand listed companies. So this is where companies on the New Zealand Stock Exchange start reporting on their results. So as a reminder, earning results generally are one of the best indicators for long-term stock performance. So earnings season is a closely watched event for many investment managers. So this brings us to the chart of the month. So here we have a reporting season scorecard from Forsyth Barr, which ranks how New Zealand listed companies have performed this earnings season based on a few key factors. So Greg, do you want to walk us through some of the factors that the scorecard measures and perhaps highlight a few NZX companies' earnings results that stood out to you over the quarter?
Yeah, sure. Thanks for Bar for providing this Manhattan. So it's quite interesting, isn't it? So effectively, the right hand side are the sort of positive surprises, if you like, and the red is less so. So hey, let's talk about the positives for a start. So A2 Milk, backed up, a lot of, and the share price in this one was actually moving ahead of the result. It was actually one of our PMs was over in China late last year and observed that the infant milk formula market wasn't declined, but A2 was winning market share. They were premiumising their product, and it was actually doing quite well. That started to be priced in by the market. Started this year, we actually added it across our funds in December, so that worked out pretty well. And then it delivered on that promise. The earnings was probably one of the strongest from the earnings season. The market is declining. They sort of reaffirmed that, but they're taking market share, and they've also got a second frontier, if you like, of growth with their move into the US. So I think investors are sort of responding to that. They've got very, very strong balance sheet as well, very high levels of cash. At the other end, we had Fletcher Building, which is arguably the worst result from the earnings season. And obviously, we've seen executive departures on the back of that. They've got the Iplex pipe issue in Western Australia. It appears like they're entering mediation on that. But, there's I suppose the provisioning that they came out with a couple of days before the result didn't sit well. The result didn't sit well. And against all this backdrop, obviously, we've got a cyclical downturn as well. We've got consents heading down. And we've got execution issues as well. So that was clearly a laggard from the result. But time will tell. Whether that sort of can recover. Obviously, we have seen those executive departures, and then in between, I think there were some interesting results as well. We had Auckland Airport. They're benefiting from obviously passenger arrivals from passengers through the terminal. That's all translating to revenue, translating to earnings. We're seeing people coming back. We're seeing more airlines come back to New Zealand. We're seeing that traffic pick up. So that was a positive. Just on that, I do think they've got some challenges potentially ahead. A lot amount of capital expenditure, potential disruption. As a result, the Auckland Council looking to sort of potentially sell some more of its stake. But it was a positive result from the earnings season. Then on the other side, you had Air New Zealand. Now you'd think they'd benefit from the same sort of thematics, but ticket prices are coming down. Jet fuel is going up. We've seen oil recently hit the highest prices this year, over $80 a barrel. So they are seeing some earning headwinds. So two very differing results there. And in the retirement sector, I think you had a really, really strong result from Somerset. Great sort of building out there, really good projects, but Ryman was sort of at the other end of the scale. But I think the overall theme of the earnings season was that, and this is how Devon's positioned our portfolios in more recent times, actually, where we do have exposure to New Zealand. It's companies that are less, because of the challenges facing domestic economy, it's companies that have more exposure to offshore businesses. So, we have names like A2, which I mentioned. We've got Freightways, which made an acquisition. They had a very good result. We've got Tourism Holdings. They have an offshore business in Australia. We've got, obviously, Fisher & Paykel Healthcare, one of the biggest names as well. So I think that was sort of a bit of a theme throughout the earnings season. Those companies which were more domestically focused, we're perhaps sort of seeing a few more challenges. I suppose the gentailers might be a notable exception, but what I thought was interesting about, they obviously have monthly commentaries or monthly trading updates, but I thought what was interesting from the reports there was quite divergent views about what's going to happen with TY. So some, such as Contact, were quite confident about negotiations there, others were less so. So I think watch that space over the next sort of 6 months. And the other big highlight that we had during the earnings season, and this was very fitting with the Oscars recently, was Vista Group. So cinema software operator, had a really tough time during COVID. The blockbuster came back. Barbenheimer was all go last year, and they had a really strong result as well. So that was one that stood out.
Beautiful, Greg. Very informative wrap up on events. So we're still early days in the year, though, with kind of 9-10 months left to go. So any kind of final thoughts on the market outlook for the rest of the year, and or how Devon's been positioning some of your funds?
Yeah, so at the moment, our Trans-Tasman funds were certainly overweight towards Australia and New Zealand companies with offshore exposure. But like any good active investor, you've got to be ready to pivot. And I think there's a couple of things there. We haven't talked about China. There's a lot of negativity around China. Obviously, it's our biggest customer. If we start to see some improvement there and some key data points, that could be very positive for our economy. We're seeing, we're quite exposed to that economy, obviously to one of the fastest growing globally. So if that's a surprise package later in the year, and the Chinese officials have committed to growth of 5% for this calendar year, that could be quite positive for a number of participants here. And I think the other big thing, as I've sort of already talked about, will be what the RBNZ does. And if we do get one or if not two rate cuts, that could really thrust the appeal of our dividend-heavy market. I think near term, there's certainly some challenges. We are, in terms of our exposure to New Zealand consumer discretionary, it's very limited. Kiwis are sort of spending less. You've gone into our shells a bit, certainly with respect to big ticket items. And I think there's some certainly challenges ahead. And we've seen various announcements from that sector over the past few weeks to sort of reaffirm that. But I think it could be a better second half for the New Zealand stock market in 2024, but time will tell.
Oh, nice. Perfect. Thanks, Greg. Well, that's about a wrap up on the InvestNow Market Wrap-Up. Greg, thanks so much once again for your time and excellent insights. If you want to check out more from Devon and all the great work that Greg and his team does, check out the Devon landing page on investnow.co.nz, where you can find out more and invest into the 5 different Australasian equities funds that Devon actively manages, which includes the Devon Trans-Tasman Fund, which has been nominated for the 2024 Morningstar Fund Manager of the Year Award in the domestic equities category. So the Devon Trans-Tasman Fund is also the reigning champ from 2023. So hopefully it's a back-to-back for Devon and the Morningstar Awards this month, Greg.
Yeah, I certainly hope so. And thanks for that, Jason. Thanks for that acknowledgement.
No worries. So great stuff. If you want to check out the market wrap-up piece that accompanies this video, check out the link on the screen. And if you want to subscribe to Devon's Morning Note, which is a helpful summary of market events penned by Greg himself and delivered free of charge straight to your inbox each morning, just register over at devonfunds.co.nz. Thanks, Greg, and thanks everyone for your time. We'll catch you next time. Cheers.